All right, the recording is on. Welcome, everybody. This is the 6th episode we will be doing, and in this episode, we will be discussing order blocks, fair value gap, and before we dive into it, we will also be discussing how to create the right conditions to identify which order blocks are supposed to be the strongest ones, which ones are supposed to be very weak, and which are actually not order blocks, because there's a very common misconception that any up candle or down candle can be like constituted as like an order block. So in theory, what an order block is, let me take a example. All right, let's go rectangle. Good. So you can think about this as a red candle. This is a down candle. And the next candle can also be like a down candle, which is like a down candle printing after the next red candle. And the third candle goes a little bit down, but it trades higher, like that. So you could make it look like this. Okay. And then the candle after that turns out to be a very bullish green candle up top. So when you're looking at something like this where the market is dropping, clearly, like, you have a very strong expansion. The next candle is also like expansion to the downside. The third one is like a middle candle. Like, it's not exactly selling off, but it's not exactly going higher either. It's like a stop kind of a candle. Like, there's a halt in the market. The selling has halted. And the candle after that sees like a very strong expansion to the upside. Where this green candle basically engulfs this down candle and this down candle all together. So the theory of an order block comes into play where you have to identify why exactly did the market form this massive up candle in the first place. Generally speaking, this turn, which has happened in the market, happens because the market has kind of ran into a massive support zone. Okay, so hypothetically speaking, there might be like a very strong SR level setting over here where the market is selling off into. And as it sells off into it, the selling kind of like slows down, and then it eventually comes to a halt. And then the day after that, a big entity comes in and they push the market higher. Now, the way this theory develops is that the entity did not just like start. Where the fuck did it go? All right. So the entity did not just like start going long on it when the screen candle printed. Yes, they were behind the buy pressure that they actually pushed it higher on the screen candle, but they were already establishing those buy orders when this selling was happening. So they were going long while the entire market was actually like going short on it because they can actually do it. Like, they have a lot of money behind it. They may have like at least $2 billion which they want to enter long as the market heads into this SR level. So what they might do is they might like when they see like this down candle, they have entered net long by, let's say, $200 million. Then this down candle happens, they go net long another $200 million. Then this halting candle happens, they might get long like another $300 million. And then this buy candle is happening, they might be like longing another $600 million based on this. So they have a vested interest that they have been establishing long orders while the market has been dropping and going to top that SR level before the market actually takes up. So by definition, an order block is that when the selling is happening, this entire down move before this upward movement happened is an order block. So this is like a zone which is created before the market taps into an SR level and it goes higher. That entire zone is called an order block. So in this case, because the stopping happened before the SR was tapped, and we had a bullish reaction happening from it, so this would be constituting as a bullish order block. Okay? So that is the most basic definition of an order block on how you should be willing to describe it. But the basic understanding is that not every down candle which you noticed before like a upward movement happened is called an order block. The key ingredient for identifying an order block is that you need to have an SR level mapped out before this zone can be identified. Like order blocks are always formed at key SR levels. All right. So that's the first requirement. First is map out the key SR level. Okay. Second is very often when market takes out the liquidity of previous swing high. Actually, in this case, since we're doing like a bullish order block, we will talk about swing low of a previous swing low and then rallies. That down candle which goes into like imagine this is a previous swing low which I mapped out, and the market sells off into a previous swing low, takes out the stops, and then rallies. So the selling which happened going into the previous swing low, that selling was also somewhat of a buying that was happening in the market before this upward movement happened. When market takes out liquidity of previous swing low and then rallies, it creates an order block in the process. Now we will identify how this would look like in real market situations so you have a better understanding, but this is more so the key ingredients you need to be looking for before we go ahead and try to identify and what an order block is. Okay, without these two ingredients, there is no order block. Okay, if you see like a down candle happening and see like an up candle happening and it's like in the middle of nowhere, that's just like a random candle. It's not an order block. Okay, regardless of how strong that push might be in the market. Now, why exactly are we like trying to identify what a bullish order block or what a bearish order block might be? The main reason is that when the market begins to rally, like let's say you rally for the next few days like this, okay, and you keep pushing higher, eventually the market is going to like top out and you might start dropping from there. You might start like a pullback or like some kind of a downtrend. Now, when this downtrend happens, like some new entity comes in and they print like a bearish block because you have hit a SR level up top and the market hits that SR level, it creates a bearish order block in this formation where you tap the SR and you basically reject it. So this zone, which is the upward candle, this becomes a bearish zone, as in like a bearish order block. Okay, and again, the key ingredient needs to be that you have hit a SR level and you had a very strong reaction from the SR level. So the upward candle going to the SR level becomes bearish order block by definition once the rejection happens. So now the market has established what you call like a range, that this is a established support zone, this is an established resistance zone. So whatever is in between from here to here, that is what you call the dealing range. All right. Basically, the participants of the market, there's a big entity over here which wants to sell it. There's a big entity over here which wants to buy it. So between these two entities, the market is basically establishing what you call like a dealing range, and it might range out for some time until like one of these entities gives up, and the market can go in like a clear trending direction from that. So when the entity is like selling this thing over here, its main premise is that it wants to take the market lower. So it would basically push the market down over here. And then when it enters this bullish order block over here, that entity which is essentially defending this position, they will have a vested interest to defend it again and take it higher. So you would see support coming at a bullish order block and take it higher over here. Again, when the market goes higher over here, the bearish order block gets tested. That would find resistance in this zone, and the market would enter a pullback as you enter the bearish resistance zone. Now, this is where like the theory of how the market consolidates is basically originating, because in between two SR levels, the market is trending first that, okay, yes, you hit a support level and then you bounce and you go to the resistance zone. So that's like one-way movement, which happens. But when you bring it down, it's not going to come down in a straight line. It might come down like in a zigzag fashion, where you're coming down, coming down, going up, and then comes down and it taps the bullish order block. It's defending it, and then it starts going up again. So when it goes up again, it doesn't really go up in a straight line either. It goes up and creates like a high, then pulls back, creates a higher low, then pushes up, higher high, higher low, higher high, and then it tests the bearish block again and reverses and goes lower. So in doing so, what's happening is that the market is like stuck in this kind of a loop where it's like contracting like this. That is what leads to creation of what you call chart patterns. That the market is basically like consolidating from this bearish order block to this bearish order block, being like the resistance and the bullish order block. So then you would like see something like this, where like quite often you would like see like a triangle pattern, or like an ascending triangle pattern, or a head and shoulder pattern of some sort. Essentially, what's happening is that the market is consolidating as it's like developing this chart pattern out, and it's recognizing that yes, this is a resistance zone, this is a bullish support zone, and it's just contracting in between that case. So when you see a contraction happen like this, ideally the market is primed up for a very big move. And that is the move you need to be concerned about. So the way this would work is that as traders, what we need to do is we need to identify what these bullish order block and bearish order block zones are. Once you have identified it, then you can like devise your trade setups around it. So if you're like obviously like if you understand that the entity over here wants to sell it, you can look into sell positions when the market enters over here. And obviously, if the entity is like it has a vested interest to take it down, so they would not want the market to go above this SR level. So you can keep your stop loss above that SR level as you identify that bearish order block, and you can target the support zone. Or you can do the opposite, where when you come down over here, you can put a buy order over here, and with the stop loss right below the bullish order blocks low, and target the SR level. But this is where the juicy part happens. That once you break this bearish order block and you basically like take it out and rally sharply from there, whatever pullback happens into this bearish order block, that's the low risk long entry, where the market it's gonna like find support over here because that resistance zone is broken. So anybody who was trying to short it, they are now underwater and they would be like scrambling to enter long positions and close the short positions out because they don't want to be in a drawdown, as they understand that this SL level has broken to the upside and it's actually turning bullish. So the first retest of a broken resistance zone, it's a very low risk long entry, and that's where the market is actually looking to trend back again. And your stop loss is basically going to be at the low of the bearish order block, and you should not be anticipating that the market is going to give out this bearish order block which it just broke out from. So that's what you call like a breakout trade. That you're not supposed to chase the breakout when it's happening. You need to be basically waiting for a pullback after the breakout has happened, and there's like a clear retest happening of a broken bearish order block. And when a bearish order block gets broken down, that the price is like actually pushed above it, that's what you call a breaker. Okay. Now there is a very specific ingredient involved in identifying the breaker, and I'll go into it after I explain this. So when the SR level actually breaks and you take the market higher and you see like a pullback happening into it, the breaker is a previous bearish order block which is now broken down, and now it acts as a support zone. Okay, so breaker is actually bullish in nature for like a bearish order block. Similarly, if the market were to actually break down, what the fuck? Okay. Let's say if the market actually did not rally, instead it went down and it broke the support zone. Okay. Then when it basically pushes up, this bullish order block is also a breaker, except it's a bearish breaker. Okay, so when you break a support zone, that's bearish in nature because the market actually wants to go lower. So when you're retesting a previous broken support zone, that is now a resistance zone. And you should anticipate lower prices on there when you break a bullish support zone, which turns into a bearish breaker. However, when you break above a bearish order block and you take it higher, then the breaker which you form over there is what you call a bullish breaker. Oh my god, my spellings. Alright, so when you break above a bearish order block and you retest it, that's a bullish breaker and that's supposed to be bought. So the market can go higher. And when you break below a support zone, which is a bullish order block, that's a bearish breaker information. And that is supposed to be sold when the market retests it. And the market is supposed to go lower from there. Okay, that's an important concept to learn, that it will ideally keep you from entering trades prematurely, that it will give you ingredients to actually involve patience on when you should be entering the market, and you will be able to recognize that when the market is rallying, where exactly you should be locking in your profits if you're long from a support zone, because everybody thinks about that, when the market is actually going up, it will keep going up in a straight line because everybody loves to see that the market is just like, going in up a straight line like this. But essentially, that is not how it goes out, right? That even when the market is like pushing, it will like go up to make a high, then a higher low, higher high, higher low, higher high, higher low. So whenever this pullback is happening, it's actually like testing some kind of a bearish order block, or like which is formed around an SR level, and the market basically pulls back from that. And if the market is not actually trending and it has entered like some kind of a dealing range, then that is the most beneficial scenario you can think of as a trader, because what that means is once this consolidation is done with, that when the market is like kind of finished consolidating, it's trying to break out and it's like breaking above a bearish block, then what's going to happen is that there's going to be a very strong trending leg, and that's where the verticality is going to start, and you will see that the market is going to go up in a higher high, higher low, higher high kind of a fashion, and you should not be like fading that trend because the market is breaking out of a very long consolidation. And whenever there's consolidation happening, you need to be getting excited about it, because anytime consolidation ends and you have a trending breakout happening, that generally is giving you signals that a new trending leg is going to start. And in that case, all you got to do is just long whatever pullback is happening in the market, and not be concerned about if the market is actually going to do like these larger swings to the downside, because you're not in a dealing range anymore. You're in like a discovery mode where the market's like discovering what higher prices are going to look like before like some new entity comes in and they punch the market down. But then new entity is not going to come in for like a very long time, like at least for like 2-3 months or 4 months, until like new sellers come in the market. So is this clear so far on the basic concepts of like a bullish order block and a bearish order block and what a breaker might be? Yeah, I will do that once I explain like real-time examples. Yeah, yeah. And the most important part is there needs to be like an SR level where this is happening. Otherwise, this whole thing is pointless. That it needs to be happening from a SR level. Okay, well, let's get into some real examples so you can understand if this is actually valuable or not. Now, this is the main reason why we need to be understanding how to map SR levels. Like, mapping SR levels is the most basic thing you need to understand first, which is why we did an entire workshop on it. And once you understand what an SR level is and how you map it, that's where the real magic begins on understanding what an order block is on top of it. So in this case, let's start from here. Why not? This is a perfectly good chart to look at on the weekly chart. All right. I'm going to draw a few levels. You will tell me on which level is an SR level and which level is not an SR level. Okay. I will assign numbers to it, and you can tell me that this number is not an SR level, this number is an SR level. All right. Now this is on the weekly chart. This level, this level, this level, this level. I can identify these 4 levels on the weekly chart. Then we can go on the daily chart. The daily chart. We can go with this level. Map it in black. Then there is there is probably this level. And then there is I want to say this level too. Okay, I think that's pretty much it. You can also like map this level and why not? So what I'm going to do is we're going to assign numbers to it. That's 1, 2, 3, 4, 5. That's a 6. That's a 7, 8. I think we covered it all, right? There are 8 SR levels I mapped out. All right. Now the work starts. Everybody give me your answers based on which number is the SR level, which is the strongest, and then map it down based on which is the weaker ones. And then if you feel like some number is not an SR level, map that number out and say that this is not an SR level either. Yeah, because you need to understand which SR levels are stronger, which are weaker, and which are not an SR levels before you can understand if an order block can be formed around them or not. Come on, hurry up. I need to know some answers. I need to be posting the charts. Yeah. I'll give you another 5 minutes. You should be able to do it in 5 minutes. For the record, it only took me 2 minutes to like map everything in my mind. Which one is a good SR level, which one is a weak SR level, which ones are not an SR level. Yes, sounds correct. 1 and 7 are the strongest SR levels. So you can definitely put them at the higher echelon in terms of which one should be considered as a strong SR level. You are right about 5 and 6 not really being SR levels. That's correct. Okay, so 1, 2, 3, 4, 5, 6, 7. What about the eighth one? You missed the eighth SR level. What about this one? You could be right, yeah. Yeah, it is a very weak SR level, even if it is an SR level. There is something you need to recall because I am pretty sure I mentioned this for mapping SR levels. So Jeff is saying fourth is not an SR level, fifth is not an SR level, eight is weak, one is strong, seven is strong, sixth is weak, third is weak, second is weak. Interesting. All right. All right. Okay. Any more answers before I resume? I think I've given enough time for the answers. Vince is like, I'm not gonna write anything. I'll just listen. All right, so let's get into it. 1 and 7 definitely the strongest SR levels. Third and second, they are the second strongest out of all the SR levels I can think of in this case. Sixth is not an SR level. Fifth is not an SR level. Fourth is like the weakest of all SR levels. Eighth is likely a little bit stronger than the fourth, just like a little bit, but it is like a very weak SR level in itself. Now, why exactly am I saying that? Let's approach the first question. Why are sixth and fifth not an SR level? One of the main definitions of having a level to be defined as an SR level is that there needs to be a very sharp move happening from these levels on either way, which fifth does not actually signify. It's just like one or two candles. Just like a little blip does not classify as like a strong move. When you look at the one SL level, the market literally collapsed after printing that level. So it printed 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 down candles before like a bounce happened. So how much movement the market covered after printing that SL level defines the severity of that SL level itself. Similarly with seventh, this was the bottom before like this entire run up happened. So the market has created a lot of time away from this level, which makes this even stronger than this one. But eventually, one is going to be the strongest out of this one as well, because this is going to be like the top of the market for like another year and a half. But at this current moment, one is not as strong as like the 7-1 at the current moment. All right. Now, why exactly is second and third second strongest SR levels? They are second strongest SR levels because look over here and here. Whenever the market is giving you clues that it's respecting it, believe the market. All right. Now these levels have not been tested, which is why we're like giving them the highest echelon in terms of severity. But this SR level has been tested, and every time you tested it, look how violent the moves were. When you see violence happening from an SR level, you have to give it respect and be like, yes, we recognize that you are like a very strong SR level because the market has respected it multiple times when it was tapped. This one, how is this being respected? Now this by itself was not defended. We went deeper into these SR levels, but the market actually violently bounced into it. Now this is where an order block is coming into play. This down candle is a bullish order block. Now, is the tube light going up in your head that you need an SR level to recognize the bullish order block, and then only it makes sense that why exactly is the market going so deep into it, and even then it's able to like bounce over here, because by itself like this bottom doesn't make sense. Like why exactly is it forming a bottom over here? Is this an SR level? No, it's not an SR level, but it's being defended because this entire down movement in this down candle is a support zone by itself, and the market is respecting that support zone no matter how deep it's going into it. And then you have like a very strong move into it to the top, respects it, comes down, goes up. So you recognize what I mean by like a dealing range? This is the entire dealing range. Because the market is trapped between the third and the second SR level, going up, down, up, down. Do you see what I mean with the example I discussed before? And then eventually it was looking like that you were breaking out of the dealing range, that you might have like a trending leg as you went up. But the market kind of like forgot that because this is an SR level, which makes this up candle by definition bearish order block. Okay. Now, even though you had a wick above it, this up candle is not really the only bearish order block. You also have to include the wick, which is the next day when the market was going up. Because when you go down on the 12-hour chart, for example, you will notice that the up candle was not limited to here. You had this up candle as well. And then when you go on the 4-hour chart, you will notice that this up candle was over here. And then this wick can be like likely be seen in the hourly chart. So starting from this low all the way to the side, this is a bearish order block. And when the market went into this bearish order block, you are basically entering the domain of the highest SR level. And it did not go all the way up to the top, but this bearish order block, which started from this bottom all the way to the top, that rejected the market. And another thing you need to realize is that when you take a fib mapping it, like let's say you map out the low of this bearish order block and take it all the way to a high over them. Okay, so you have this entire range. When you dissect this range like this, the midpoint of the range is a very, very strong SR level. So when you go on the hourly chart, notice how the market was like going up hormonally. It went into that, tested this hourly bearish order block, which is sitting at this midpoint level, and then it tapped it. Notice how the market structure just like shifted from that. You were then dealing with bearish market structure, right? That you had a high, there's a low, there's a lower high, a lower low confirmed. So when you see something like that happening after like testing a bearish order block, which is formed at the highest precedence of the SR level, that's where you need to be kind of like shifting your bias from like being bullish to being bearish. Okay. Now this is a classic failed breakout scenario where you try to exit this dealing range thinking that you are going to have a trending line to the upside, but instead you started faking it out and you re-enter the dealing range after taking out all these stops into the bearish order block up top. Now, when you see something like that happen, you need to be on the lookout for a short opportunity. Okay. So in this case, when we tapped the bearish order block and it came back down again, then guess what? This SR level, it never held as a support zone. Now, if you come back to retest it, that's a short, because the market respected this SR level for resistance. Now let's see what happens. Punches higher. It did not actually respect the exact SR level, but I can see over here that in this case on the 4-hour chart, This is a 4-hour bearish order block because this is an SR level on the 4-hour chart. Locally, it's an SR level. You tapped the SR level and then you sold off aggressively going down. So when the market is like reaching for this up candle before the sell-off happened, it's testing a bearish order block. Do you see the beauty now? Now, when this down candle got printed like this up candle is now a bearish order block because it's being formed at a key SR level, which was tested once, twice, maybe gave up, but then it came back down again, went up, rejected it. And this rejection is happening at a key SR level. So this entire zone, from this bottom all the way till like, basically from this bottom till this top, this zone is a bearish order block. So any trading which might happen going into this entire zone, that's a short. All right. Now what happens the next day? Booyah! You went for this low because there was a fake out on the dealing range. You rejected the SR level, formed a bearish order block. When you form that bearish order block on the daily chart, that's a very high significance that the market is going to go down. It's not going to go up. Like when I was saying that, if it comes back up to retest it, that's a short. It doesn't have to happen because you have already formed a bearish order block. This is for in the future when the trend actually turns bearish, when the trend actually turns bullish after doing this drop and you come back up, you can short this when the market actually re-enters this bearish order block in the future. It doesn't have to happen the next day because once you print this bearish order block, the bias is to the downside then because anybody who was trying to long this breakout, they're trapped now. The moment this bearish order block got formed, anybody who was long, they were trapped, right? And you should be like looking to go short on that bearish order block formation. And when you came down, what happened to the fifth one? Nothing. The market just like pierced through it, right? Now the sixth one, even though I mentioned it's not an SR level, I will tell you why it's not an SR level. Even though you're seeing a reaction, it's not going to hold over here. See? Didn't hold. Just went down. So let me take back a little bit. Why is this not an SR level? This is not an SR level because even though you had some kind of a sell-off happen over here, look what happened when the market came down on the first test. Did not respect it. Went up, did not respect it. Came down, did not respect it. Started going up, did not respect it. So when the market is not respecting, it's just going up and down from that level. It is not an SR level. Just take it out. The market doesn't care about it. All right. So in this case, this is obviously on an SR level. We're taking that out too. This, in my opinion, is the weak SR level. Like it's the weakest, as I've said, because just one pullback, it does not really make it an SR level. I started it from here for a reason so that you can like learn to identify that an SR level, if it has to begin, there has to be like a sharper pullback happening from that level before you can map it out as an SR level. So in essence, this is not the origination of the level. This is the real origination of the level if you have to map an SR level. So you can like map it out like this. You should not be mapping it out like the way I put it over there. Okay, so that was like a deliberate mistake on my part to showcase to you that you should not be starting an SR level from like a candle which does not really have like a proper swing formation. Like this is the proper origination. This is a proper origination because you have like a daily lower high. And even then, this is like a very weak SR level because the market did not spend like a lot of time going away from it. And even when it went up, it casually just like went past it without giving you any kind of a pullback. So the market doesn't care much about this SR level, is what I would say. Like this is a weak SR level. All right. So now that you know that how to spot like a bearish order block, how to spot like an SL level, why exactly is this like a bearish order block? Because you have a prior SL level information. This is also like a bearish order block, but it's not visible on the daily chart. You would have to go back on the lower time frames to see how there is an order block over there and why the market got rejected over there. You'll have to go all the way down to like the hourly chart to view it, that there was like a hourly bearish order block, because this up candle is setting right at the highest echelon of the SR level, and when you came to tap this zone, the market just like completely collapsed down the way, which makes this the highest SR level out of all the SR levels which you mapped out. Okay. But since you broke below this bullish support zone, this now is irrelevant in my opinion. As in, like, it should not be acting like as a support zone anymore, but you could possibly use it for like a pivot of some sort. That the market can likely use it for finding resistance once you have like a clear trend breakdown, and then you can like see some kind of a bounce happening. And this will be used as like a breaker. This can like transcend into a bullish breaker in the future by itself. However, I don't particularly like this as a bullish order block. But yes, this is a bullish order block, but it's not like a very strong bullish order block. This is what you call like a weak bullish order block, because this down candle was responsible for causing upward movement, but this upward movement was very lethargic. Like, you had to take 3 up candles to actually create this bullish order block. In essence, if you had to qualify like a bullish order block as a strong one, I would. Which one should I use? This is not a strong bullish order block because it's being formed at a very weak SR level. I would not really qualify this down candle as a bullish order block. But you could likely consider this down candle as a bullish order block. But even then, the upward movement, it took 2 up candles on the daily chart. It took 2 up candles on the daily chart to actually form this bullish order block, and on top of it, you see like a flat open, right? Whenever you see like a flat open sitting at inside a bullish order block, that is not a strong bullish order block either. That is a weak bullish order block. So I don't like that one either. And on top of it, there are equal lows sitting over here. So I don't like this low either. That you should not be looking for bullish order blocks in this thing over here. In essence, there are no strong bullish order blocks from what I can suspect over here. So this entire rally is like a very weak rally, even though you're seeing the market go up, but the lows which are printed, they were not like strong lows. They're like very weak lows. So they're susceptible for like a rundown in the market. So in essence, like, yes, this is a strong SR level. This is a strong SR level. This is the second strongest SR level. This is the third strongest SR level because the market's like respecting it at this bullish order block. Even though it's like a weak bullish order block, but it's giving you reaction out of it, right? So the market cares about it. Now this is a very strong bearish order block. If the market were to come up till here, that's a short. Now let's see what happens. See, market's not even respecting that. So would I be correct if is this going to be like holding as a bullish order block or no? No. See, I was right. You should not be using that as a bullish order block because there's a flat open over there, and this down candle is like literally finding support in the middle of nowhere. There is no SR level at here. This is the SR level. All right. Like, this is not an SR level. If I were to like make this as a level, there is no SR. That's just middle of nowhere, right? So that's why not every down candle with like an upward movement is an order block. That's an example for you to learn. And then finally, when you go for this low here, now why did we see such a down move like this and we actually closed bullish on the day? The main reason for that is that this was a quarterly low, I believe. whenever you are going for like a quarterly low, the market goes bonkers. That a lot of big institutions are getting their ass wiped clean. All right, and it's common to see such a strong down movement because a lot of stocks are being triggered and a lot of people are getting liquidated in their position. All right, so even though you're forming an SFP over here, if you were trying to long based on this for the next day, now in general, I think the market should go up on the next day because of this long wick, but I would not be longing it just yet because the sell pressure is just too strong. I need a formation of some kind of a bullish order block at this SR level if I have to go long. All right. So let the market do its thing and tell you if there is like a good chance for it to go long or not. And in order for like a bullish order block to form, the market would have to trade above this down candle to confirm like some kind of a bullish order block formation. But ideally, you want to see it happen in just one candle, not like 2, 3 candles. The average right should not be longing it. That just because there's an SFP, you need a bullish order block formation after an SFP formation to get like a confirmation that the market's going to bounce or not. Now here, that's our first strong bullish order block because you have an SR level, you have a down candle, and the up candle basically completely engulfs this down candle over here. So now you need to be on the lookout that you will be going up. All right. That is how a bullish order block formation looks like. Now, Jeff, I think you can ask me, what is a breaker? Like, how do you know a breaker is going to be forming or not? Now, in this case, I can show you what a breaker is. Now, when the market is selling off, one of the first things you need to look at to spot a reversal is to see if the market is going to form what you call like a bullish breaker. Because a bullish breaker will be formed when a bearish order block is broken down. Okay, so in this case, we know on the hourly chart that this is a very strong SL level. All right, and when the market went up over here, I'm going to take this again. It formed this swing high, right? It's a very clear swing high in the market. And when you ran this stop, initially went down, you created a bearish order block in doing so on the hourly chart. Okay. It should look like this. The first up candle before the down move happens after taking out a previous swing high. Remember the requirements I posted. I don't know if I still have it. I should have probably saved it. But it's recorded, so you can like look into that thing when I was writing the requirements. When you take out a previous swing high and then you reject it like this, that's a bearish order block. Even though this might not be like a SR level, but that's a swing high. That's a very clear swing high. And you took out the liquidity and then you rejected it. That's a bearish order block. All right. So once you take out a swing low after creating a bearish order block, that validates as a very clear resistance zone because whoever sold the market over here, that was responsible for the market structure to turn bearish. Now, what do I mean by that? When the market bottomed out over here, that's a low, that's a high, that's a higher low, that's technically a higher high, all right, because it found that high over here. But since it formed a bearish order block, and when you went down, you took out this low, you made a lower low. This bearish order block was responsible for changing the market structure from technically being bullish to punching it down to being bearish. All right. So when you have a bearish order block which was responsible for changing the market structure to be bearish by taking out a previous low, that's something to be monitored in real time as the market is developing. Because when you come up, it may have rejected this SR level over here, went back down, it made another lower low. So confirm this as a lower high. So when it's punching into this resistance zone, trust me, there will be a reaction out of it. However, when this bearish order block flips, that will be your breaker. The whole point is that this bearish order block should be responsible for taking out a prior swing low before the trend reversal has to happen in order to qualify as a breaker. All right. But let's say if I mapped a bearish order block which went down but did not take out the swing low and just like made a higher low and basically like took the market higher, then it is not going to qualify as a breaker. The whole premise of actually having a breaker is that this sell-off was responsible for taking out a major liquidity pool, which was this higher low in this market. Okay, that's the first requisite. The prerequisite in this case is that this breaker has to take out a swing low, which it did. Now this is a very valid resistance zone because it was responsible for changing the market structure. And now when price tags it and breaks above it, it is now a bullish breaker. Okay. So after this bullish order block was formed on the daily chart, you should be paying attention to what that bearish order block was doing on the hourly chart. And your bias should be like, okay, that bearish order block is going to go buy high. Because the daily chart trumps the hourly chart, right? If you have a bullish order block information at a very key SR level, which was the red SR level, this hourly bearish order block is not going to stand in its way. Like, the hourly bearish order block is not going to be the one stopping the market from doing like a daily trend reversal, all right? So what that means is, if the market or when the market comes down, it will be finding support at this 4-hour breaker. Now, that hourly breaker I was talking about, it transpired into a 4-hour bearish order block as well. Like, let me map it out like this so that it makes sense. Like that. So this up candle on the 4-hour, which had this massive sell happen over here, took out that low over here as well, right? So when the market actually bounced and it went into this 4-hour bearish order block, you actually had resistance. The 4-hour bearish order block did its work. Even though I was mapping out just like the hourly order block, right? But this entire zone is the up candle before this sell-off happened. So when you re-entered in this 4-hour bearish order block, you had the SR level, which is this one, the strongest one. You have the bearish order block on the 4-hour. This was a sell, and the market respected the sell. It actually like went lower. It took out the low. But then someone entered the market, be like, nah, I don't want it to go lower anymore. And it brought the market back up again. And in the process of doing that, it created a bullish order block at the key SR level, which is the most important thing in this case. You need a combination of a lot of things to confirm like a bullish order block. You need the key SR level, you need the down candle, and then you need the entity coming in like in full force, engulfing that down candle, trading above the SR level, confirming that they are serious about like reversing the market. So in that case, the 4-hour bearish order block is not going to stand its way. The hourly bearish order block is not going to stand its way, right? And you notice that there's some kind of a consolidation, and the market eventually pops from there. That's how you can like do preemptive strike, thinking if a bearish order block is actually going to hold or not. Even though on a technical basis, this bearish order block is setting at the PSR level, and the first test is always a sell. The second test, not so much, and it like eventually goes. So if the market were to come back down and test this area, this entire area, I would say. Let's just say this area. That is a breaker. All right. That is what qualifies as a breaker. No, but the market has already like punched higher, so we'll see if it actually like comes back when it pulled up or not. Now I did mention that this is an SR level, but it's a very weak SR level, and you can see that the bounce is like very weak as well, and then it like punched below it. But we'll see what happens from here. It did not even respect that SR, just punched past it. You see that? What happened here? Once I mapped the breaker, went higher, lower, goes under, and then boing. This is the power of a breaker. That once you do like a retest, that's a broken resistance zone at a previous ESR level, comes for a retest, and then it's like a bazooka shot from there when it came back down. This is where I would be longing it because it's a key ESR level test. Even though you know it's going deeper, like you are essentially looking at this entire zone, right, which is a breaker, and we are basically trading in this bullish order block. So this entire down move is a support zone. I would personally be concerned with this bullish order block, not with the breaker itself. The breaker is not that high of a support zone as much as this bullish order block is on the daily chart, because the breaker is on the hourly chart or the 4-hour chart. That's a smaller time zone. It already did its job, right? That once you tested it for the first time, it bounced. That's its job, done. Second time, it's okay to make a new low because you're going for like the SR level test, but you're still in the 4-hour bullish breaker. But what's more important is that you have this entire daily zone over here, and you should be taking a fib from this low all the way to this high. Okay. Now, why exactly is the 0.618 overlapping with the SR level? Because the algorithm knows that this is a very strong SR level, and I want this thing to defend over here. And that's how they measure this entire move when they bounce it from here all the way to there. Okay, so you should be like longing blindly at this SR level with a stop loss below the 0.705, because it could likely go to like the 0.705 as well if it has to. But in my case, I would be more so thinking that when this pullback happened, there's an inside daily candle, it tapped the SR. So now it's like playing coy with this 4-hour SL level as well inside the 4-hour breaker. That, in my opinion, would be a long. I would be longing this. Like, this SL level would be long, but I would be longing this, and I would be at least taking it to this here, 15731. Oof, that would have been bad. That would have been very bad. All right, what happened over here? Let me take it. Right. Now this was a long, which is great. Now main issue, which really came up, was even when you did make this bounce happen from this key SR level, you made a run up into the 0.75, and there was a very clear, that's not visible on these time frames. Okay, it's probably visible on the 2-hour chart. At that SR level which I was talking about, it's a weak SR level, but because the market is also super weak, it's just using whatever SR level comes into play, and it rejected this bearish order block over here. Now, would I have known ahead of time that it was going to do that? No, I don't. I personally would not have known because I was looking at this SL level and I was thinking that this is finding support and it's bouncing, it's creating a market super shift. But what I should have done is look at the weekly chart and be like, I realize that the market is bouncing from here, but since the market structure on the weekly chart is bearish, it is coming in to a weekly bearish order block over here. Okay. Now this weekly bearish order block is forming at this SR level, so it qualifies as a pretty solid bearish order block. That this sell that happened with a weekly bearish order block. Now, because I was very fixated on the lower time frames, I caught the bounce which happened after like taking at this SR level, but I forgot that when the bounce is happening, it could potentially make a lower high on the weekly chart. All right, so even though we were looking at the daily low being formed, I should have been on the lookout that a daily lower high could be formed because we are trading in a weekly bearish order block. Right, so I missed that thing personally. And instead of like this SR, should have been looking at this SR. That when this bounce happened from here, that's a solid SR level. Okay. And you can take this thing out. Now this one formed when this drop was happening, so I did not like include it in the initial analysis because I was looking at the left-hand chart. All right. But in this case, even though you were finding support on the daily support and just providing you bounces, what was happening over here is that there was a trend shift happening on the daily chart as well. That you had a lower high being formed on the daily chart in comparison to this one, where this all happened. It came up, it confirmed that this is a lower high by creating a new lower high, and in doing so, it created what I would call, this is something new. This is not a bearish order block. It is what you call propulsion block. This is a bearish order block. Now, why is this a bearish order block? Because you are rejecting it from a weekly SL level, which is over here. All right. This was the main low in the market before you basically collapsed it all the way down over here. So when the market bounces, it finds resistance over here, you actually sold off. Now, the whole definition of a propulsion block is that when the market forms a bearish order block off of an SR level and you take it down, and when the market comes back for a retest and it rejects it on the retest and forms a new bearish order block inside the previous bearish order block, this new bearish order block is called a propulsion block. And that is also a very, very strong resistance zone. Like this is the second strongest resistance zone you can think of after the bearish order block. So if the market were to come back into it, it will offer resistance into it. Okay, so that's a propulsion block after you form a rejection off of the bearish order block. And then it finds support over here, bounces again. That is the daily bullish order block doing its work. When it comes down for the first test, you have a bounce. Second test, there's a bounce. So the market is not going to go past that daily bullish order block in a straight line. It will have like a lot of trouble doing that. So after that daily propulsion block was formed over here, I would recommend to go lower time frame over here and then look for rejections happening in the 4-hour chart as well. So once this daily propulsion block was formed, which is like this upward movement, notice when this sell-off was happening, how exactly the market was bouncing over here and then doing the sell-off. So it broke this SR level by doing this bounce, testing a propulsion block on the daily chart and then doing the sell-off. So essentially, this 4-hour bearish order block, a new one, which is formed, that should have held as resistance. which it did, and the market bounced into it, found resistance, and then went back again. It's a very valid order block because it's forming at a SR level over here on the 4-hour chart itself. Like I mentioned on the 4-hour chart that this is a key SR level. It was responsible for forming a bearish order block over here, punched it down, and then eventually when the market broke out over here, came back down, retest, bounce, 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 bounce. So the SR level was holding it. When it eventually came down, it tested the SR level for support. There was a bounce, but somebody pushed it down and broke the SR level to make it turn into a resistance zone. Now, when the market bounced up, notice how the market actually did not respect the SR level. It went into the bearish order block and then rejected it. Came down, up, down, 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 down. That's how bearish order blocks are coming in handy to give you more of a leeway when you're trying to enter positions. So let's say if you were entering short on this SR level and you're trying to take the market down, where do you put your stop loss? Like your stop loss is not going to be all the way up top of that for this case. Even though that's the propulsion block, and you'll be thinking that based on the daily chart, the stop loss should go above the propulsion block. But what you could do is put your stop loss above the 4-hour propulsion block. That's fine too, and that would not have gotten stopped out and take it all the way down to that would have worked perfectly fine. So when you go from like daily resistance zones to like lower time frame resistance zones, the 4-hour order blocks are also forming at the key daily SR levels, which you map out, and they're very handy when the market actually respects them. Okay, so in this case, if we were to look at the trend overall on the daily chart, this is looking like a lower high in comparison to that high. That's another lower high, lower high, lower high, lower high, lower high. And then eventually if it comes up and again, that might be like another lower high and it should go down. That's cute. Okay. But keep in mind, this is still a very strong SR level, even though, it has gone below it. Since it has gone below it, I would think about this as when it comes up into it, there will be a reaction happening from that. This is a new SR level for our case. Then, now the reason this is qualifying as an SR level is because when the market did a severe bounce and went down, when it came up, it respected as a resistance zone and then it took it down. And then it formed a propulsion block on top of it. Now we have a bounce happening in the market. Now on the 4-hour chart, I could technically use this up candle as a bearish order block. I don't like it, I'll tell you that much. Now this is a distinction you have to learn. This is a learning moment. This up candle is not as strong of a bearish order block as this 4-hour bearish order block is. Now take notes on this one, you will use this concept a lot. The way this bearish order block is formed is very different from how this bearish order block is formed. What's the difference? The difference is the sell-off which happened after forming this up candle. How many candles did it take? 1, 2, 3, 4, 5. So it's lethargic. It's not quick. It's not strong. When you see lethargic stuff happening after an up candle, that's a very weak bearish order block. You should not be treating as a bearish order block. But when you see something like this, where you have an up candle, and the next candle which forms, it actually goes up first, takes out the previous 4 hours high, rejects it, goes down in one single push, and closes below the 4-hour candle's low. That's what makes an order block the strongest order block. All right. In this case, what happened after you printed the up candle? This 4-hour candle did not. go above the previous 4 hours high. Okay? Since it did not manage to do it, this is a weak bearish on block. However, when you do the stop run first before you take it down, that means that the market is serious about the sell-off, and that's what makes it a very strong bearish on block. So I can be more convinced that when the market retested it, it's going to reject it. However, in this case, I would not be convinced if the market is going to test it, it's going to reject it or not, because the stop run is not there. I would much rather see it go all the way till here for this better order block test for the second one to show it all down. But let's see what happens. Because that's the SR level doing its work. And as I explained over here, when you see something like this, where the market punches an up candle and the next up candle actually takes out the previous 4 hour candle's high and then sells off and closes below the low of the candle, that's a bearish order block. Now, is this bearish order block gonna hold the market and actually take it down all the way till there? Possibly, it can do that. Definitely can do that. It has also taken out these lows, right? So they were all the signals that the market should be shorted over here because you tap in SR, there was a premature high, did a stop run, took it down, and you also took out the lows. So that's a very strong bearish order block in this case. Well, let's see. I'm actually curious what happens. Notice what's happening here. When it took it down, the market bounced from here. It formed a similar bearish order block, right? Now this bearish order block does work. It's making the market collapse. In doing so, it created another bearish order block, made it collapse as well. But what's happening now is a bit intriguing to me because technically you have not made a lower low. It's kind of like a higher low. And it will be confirmed as a higher low after you take out this resistance zone. But this is where this question needs to be answered again. If you break above this 4 hour bearish order block, would that classify as a breaker or not? That is what you need to answer in the discussion floor. Is this going to be a breaker or no once it trades above here? It's just a yes or no question. You can just write yes or no. Is this a breaker or no? All right, Miss Jeff says no. Oh, others also need to answer. They're all listening. All right, not a breaker. No, it hasn't. No. Tom says no. Matt says no. Matthew, I'm waiting for you. Come on. Matthew's sleeping. I think he's busy with his baby work. All right. Yeah, this is not a breaker. This is what you would call, if it breaks, mitigation block. This is a new kind of a block we're introducing. All right. A mitigation block is just another bearish order block which flips the market structure without taking out the prior swing low. All right. So if the market punches above that, it will be called a mitigation block, not a breaker. So on the precedence level, bearish order block is the strongest. Then breaker comes after that. No, sorry, propulsion block comes after that. Then a bearish breaker comes after that. Then lowest is mitigation block in terms of severity. So what would be a bearish breaker? A bearish breaker would be where a bullish order block has been flipped, and you're coming down to like a test intense. Okay, I'll have to show you an example to like give you some perspective on that. So this is the bearish order block. A propulsion block was over here, right? I mean, technically you did test the propulsion block and it rejected it. So that's the second severity one. I can change the color on that. So this blackish one is the propulsion block. Red one is the bearish order block. You came up to test the propulsion block. You formed a new bearish order block. Came down. If this thing actually flips, then it would be what you call a bullish mitigation block, because you're basically flipping a bearish order block to turn into a mitigation block. Okay. So in the same case, if a bullish order block was flipped and you created like a bearish mitigation block doing that, then in terms of severity, that would be like the lowest echelon in that. We don't have an example in this case. I've already showed you what that would look like. So in this case, even this is not a good example because we're in like a bearish environment. This might be like a good example over here. So in the bullish market, like this could be classified as a bullish order block. All right, because the 4-hour candle took out the low here, and then it punched higher, closed above it. And this bullish order block took out this high over here as well. So when you actually broke below it, this became a bearish breaker. All right. So when you came up for a retest, that was a resistance zone test, and you broke below it. Okay. So this is like the third strongest out of the bearish scenarios. What would be the last weakest one if this bullish order block, when it was formed, there was no swing high, as in like there was no swing high at all, and you could possibly think of this one, even though this is probably not like a bullish order block. When this bullish order block was formed, that this was a stopper and it went up, so there might be like a bullish order block in between it, but I'm using this candle just for like example purposes. When this thing went up, this high was not taken out, and then it went below here, right? So this would classify as a bearish mitigation block, right? So in terms of severity, this is what I mean to say, that bearish order block is the strongest, propulsion block, this one, second strongest, bearish breaker, which was over here, third strongest, bearish mitigation block, which was over here. That's the fourth, last one, last of last. So these four are what you need to be concerned with. Bearish order block, propulsion block, bearish breaker, bearish mitigation block. Similar things would be discussed for bullish markets in terms of bullish order block, bullish propulsion block, bullish breaker, bullish mitigation block. Is that clear so far? Or something is unclear, please let me know before I proceed forward. Yeah, it's the definition which needs to be clear first so you can like start mapping it out in real time as we go forward. we'll do like a plenty of examples. I'll like quiz you nonstop for like an hour about what constitutes like a bearish order block, what's a propulsion block, what's a bearish breaker. Like once you do those examples with me, that's when it will start clicking to you if you're looking at the right thing or not. Sure. So a propulsion block is when you have a bearish order block, which caused the sell-off to happen in the market, and the market retraces back into this bearish order block, and the market resumes its downtrend, the downside, and while doing the resumption of the downtrend, you create a new bearish order block inside the previous bearish order block. Okay, so in this case, this would be the propulsion block because it's forming by testing the previous bearish order block. Okay. So I think I've covered enough setups for the bearish one. Let's go into the bullish one, but I will do the bullish order block scenarios by quizzing you guys to actually have a decent understanding. Like use the same definitions I taught you about mapping bearish order block, propulsion block, bearish breaker, bearish mitigation block, but just do it in reverse. And the best thing is like I taught you the bearish stuff first because bear markets are rare, that they don't happen like often. But bull markets are here to stay for like a very long time. So drilling in the concepts about bullish order blocks, bullish propulsion blocks, bullish breakers is far more important than whatever bearish stuff is happening. Okay. So when we're going to do the exercise with the bullish stuff, that's what you need to be like more concerned with, if that's going to be like visible to you or not. Okay, so I'm gonna go into like a bullish environment, and we're gonna like do something over here with this. Okay. All right. I'm gonna take this out. Let's go here. Okay. Now this is where we're gonna be starting the quest part, where you'll be asked to answer questions in regards to: do you recognize any bullish auto blocks, bearish auto blocks, bullish breakers, bearish breakers, propulsion blocks, and mitigation blocks? Okay. Now the first thing is mapping the SR levels. I'm just gonna do the SR levels for you because I assume you guys understand on what are strong SR levels and what are weak SR levels. So in this case, this is a very strong SR level. As you can see, this market defended here, resistance, resistance, and then down below, this is a very strong SR level too, because the market like did a very sharp swing from there. Then over here, I would possibly use this as an SR level because the market respected this, respected this, respected this, even this. There are like at least 4 respects which were done. So that would classify as an SR level. What else? What else? What else? I would possibly use this as an SR level too, but it is forming at a previous SR level, so you don't really need to add it. And then there is this one as well. There is this one as well. So do you guys see anything else which I'm missing? In case I have missed something, or just like blindly having faith in me that I have got everything. Any SR levels which I've missed, which you would like to map out? I missed this one. So it looks like we were going with blind faith. That Fennec is just going to cover everything, and there is not going to be anything missed. There's this one, yeah, where you defended this over here. Eventually, there was this reaction too. Okay, I think we have all the SR levels. So now let's start with this downtrend. I'm going to map all the order blocks, so you will tell me which order block it is specifically. Okay, this one. Now I'm going to assign it different colors, so you are able to tell me based on the color that which color represents which order block. All right, for the bearish stuff, this is it. How would you define these order blocks? Write your answers based on red is this, blue is this, black is this, purple is this. There are 4 order blocks. I need to know the answers for all 4 of them. So you have to tell me which order block is defined based on the definitions I told you about order blocks. Is it a bullish? Is it a bearish order block? Is it a propulsion block? Is it a breaker? Or is it a mitigation block? Out of these 4 order blocks I mapped out. That's the question, which I've written in here. For these 4, how would you define them for these 4 of them? Yeah. No. So that's also a question. Yeah, I will go into it. That you need to be able to identify that why is the other two not here? That why did I like introduce it in the question? So you see, I'm like trying to mess with your thinking as well. It's not supposed to be that easy. Sam says this purple is bearish order block, not auto block, order block. He would be wrong to say it, but at least he's trying. It's not a bearish order block, the purple one. Red is bearish order block. Blue is bearish 2.0. Good. Black is mitigation block. Purple is propulsion. Interesting. Okay. Red is breaker. Blue is propulsion. Okay, so Jeff fell for my trap. There is no breaker in this chart. A bearish breaker would require the formation of a bullish order block being broken. Okay. So in this case, a bearish breaker would be this candle, where the bullish order block gets broken down and it gets retested and you sold off. So that's the bearish breaker. The previous bullish order block, which does not hold as a support and takes the market down, that acts as a resistance. So that's the bearish breaker. This one is a bearish order block, the red one, which Miss Jeff got right. The blue one, which she's saying as bearish 2.0, is the propulsion block. It's not a second bearish order block, it's a propulsion block. And Jeff got that right because when you were pushing higher, you see this wick, it traded inside over here. So this entire zone from this bottom to this top is actually a bearish order block. Any upward movement which happens from this SR level, which causes downturn, is a bearish order block. Now, I may have just mapped out the daily version, which is this up candle, but if you go on the 2-day chart, you will notice that there is this over here as well, which is the 2-day bearish order block. So in essence, when you were going up and you retested this bearish order block and you formed this massive spike down, you were creating a bearish propulsion block. Does that make sense? If it is not clear, let me know. I can explain it again. All right. So the SR levels, I suppose, are clear, which I have put in. This is a major SR level over here. And we are creating a bearish order block on top of it, which I think most of you got right. But this is a bearish order block. Now, after this sell-off happened, just this one candle is not the only bearish order block. This up candle, prior to this up candle, is also part of this whole bearish order block territory. Because if you zoom out, like if you go on the 2-day chart, you will notice that this upward movement happened from this low. Okay. So from this bottom all the way to this top, that's the territory of the bearish order block, which might be visible on the 3-day chart as you keep zooming out. Now on the 3-day chart, there is no bearish order block, right? Because it's just like one downturn movement. And this up candle, like from here to here, it's visible on the 12-hour or on the daily chart or on the 2-day chart. So on the 12-hour, you will see continuous up candles being printed. 1, 2, 3, 4. But only on the daily chart, it's visible as a proper bearish order block, right? But on the 2-day chart, you will realize that there is a 2-day bearish order block as well in this formation. It's only after you go on the daily chart you realize that, yeah, this is not the only part of it. You have to include this as well. So this is the bearish order block overall. Is that clear? Okay, good. So since we know this is a bearish order block, because it's formed at this SR level, when the market bounces and trades within the territory of this bearish order block, it rejects it. Now, what is the definition of a propulsion block? The definition of a propulsion block is that when you're testing a previous bearish order block and you form a new bearish order block by testing the previous bearish order block and you cause a sell-off, that makes this a propulsion block. This is not a second bearish order block. This is a propulsion block because you're forming it by rejecting the previous bearish order block. Is that clear? Good. So once you punch the market down, you made it go below this SR level as well. And once that SR level was taken out, what happens? You do a bounce, and the next candle, if you look closely, it takes out this candle's high. There's a liquidity run. Remember, the ingredient has to be there is a liquidity run before you take it down. And it did. It closed below it. So that's a new bearish order block. All right. This is bearish order block 2.0. It's a new bearish order block. And then eventually, when the market punches up again, tests this bearish order block at this SR level, rejects it, it makes this a propulsion block, because a propulsion block is the retest of a previous bearish order block as it goes lower. Is that clear now on how they should be labeled? Now you might be asking, hey, you asked us to map these things out. Where exactly is the bearish breaker or bearish mitigation block? Now the reason I mention these things so that you would be forced to think that what is the formation, the signature of a bearish breaker and bearish mitigation block. Bearish breaker and bearish mitigation blocks are not formed by up candles. They are formed by down candles. So in order to map out a bearish breaker and a bearish mitigation block, you would have to look at an uptrend when it's being broken down. So I'm going to take this out to highlight what that looks like. Fuck. Okay. So since this is an SR level and you are forming like an up candle, this is a bullish order block, right? Now, when this bullish order block breaks, would this be classified as a bearish breaker or a bearish mitigation block? This is your next question that you need to be answering. This bull candle, when it broke down, when price broke below it, would that be classified as a bearish breaker or a bearish mitigation block? Let's just say as mitigation. The one I've highlighted, 9th August. This is the breaker. And I'm not saying, okay, I don't know if this is a breaker or a mitigation block. I'm asking you. But this is like a bearish order block because a previous bullish order block, which is broken, is a resistance zone. This was supposed to be a support, but it's not because it broke it down. So it turns out to be a resistance, and you can see the market reacted to it. So what does it make it? Is it a bearish breaker or is it a bearish mitigation block out of all the order blocks we have talked about? You are right about this being a breaker, but for the wrong reasons. Like, think about the definition of a breaker. A breaker is only formed when an order block takes out a liquidity pool. This order block, which liquidity pool did it take out? Sitting right here. These highs, which is sitting over here. So this down candle was responsible for thrusting up the market to take out these liquidity pools. And it should have held for support, but it didn't. Punched below it. So this makes it a bearish breaker. It's not a mitigation block. Now I understand this is like an advanced level concept, which is it's going to take some practice to actually get some handle on it. That's how to view it. But this is like a very prime example of how to view a bearish breaker. A mitigation block would be, I don't know. So it's hard to say. Like this is probably a mitigation block. Like mitigation blocks are hard to find. Like they're the weakest of the weakest bunch. So the market barely prints them. Like it's not important to actually learn what a mitigation block is. I'm just like telling you based on like theory purposes. Like they're the weakest of the weakest bunch. It's the breakers which you need to be able to like spot. When you spot them, they're really handy. That you're able to recognize that there's a market structure shift happening because breakers signify that there is a market structure break happening because a higher low is being taken out, right? That's generally where, like, whenever you take out a higher low, just assume that there is a breaker in formation, like a bearish breaker, all right? Which is one of the main reasons I was teaching you about the market structure part first. Because once you understand the market structure, everything blends in with the order block theory as well. That a higher low being taken out means that a bullish order block is being broken down. And a bullish order block being broken down means that a support is being broken down. And if a support is being broken, now that means when the retest happens, a new bearish order block is going to form in its place. And that is how it's going to look like. So essentially, bearish order blocks form at previous bearish breakers, right? As hard that might be, this is like a light bulb moment where you're like, okay, well, it makes sense now because this is like a previous support. The support was broken down, it turned into a new resistance, and that new resistance is the bearish order block. Does that make sense? Yeah, it all blends together. Like it takes some practice to like view it as you go forward, but once it starts making sense, then you can like anticipate in real time that yeah, I recognize this is a very strong bearish order block. So when it comes here, I need to be shorting this. And this was a CPI day, I remember, where like all the central banks were like lined up thinking that CPI is gonna come lower than expected, but it came higher than expected, and the entire market just collapsed on it. In hindsight, it looked like no, it was like testing this bearish order block. But let's say you did not know about the news event, then I would be shorting this. I would have limit order setting over here with the stop loss right about that, right? And on top of it, you could be taking a fib from here all the way till that. Look at that, 0.75. So when a fib level is lining up with like a bearish order block, which is lining up at the major SL level, you can go balls deep on that position. That is where order block theory really helps with your risk reward ratios. That you can be more confident that I understand this is a bearish order block, so my stop can be like right above this top, like which is not even at the wick, just like above the body's top, and I can be like looking for massive downturn till here because I'm thinking like a massive downtrend is gonna unfold after this bearish order block is tested and go for this low, this low, this low over here, right? So that's an example to think of. Now let's do an example for bullish order blocks because that is more important to recognize. But hopefully, like since you are able to recognize what a bearish order block looks like, what a bearish propulsion block looks like, what a bearish breaker looks like, you can like flip it and you can spot it for bullish environment as well. So in this case, same SR levels because SR levels don't change. Like I don't have to change it. I can. All right. Now this will be like a test question because anything which was like a bearish order block, it flipped. Now you get to answer if it is a mitigation block or if it is a bullish breaker. So this will stay. The new ones which we will introduce over here, this one. Actually, no, I need more data. This data is not sufficient. This one here. And then this one here. Let's say. Okay. Yeah, I think that's good enough. Let's take it out. Put it purple. Let's do this as blue. All right, so between green, red, blue, and purple, you need to tell me which auto block is this. And the four options are the same. Is it a bullish auto block? Is it a propulsion block? It is a bullish breaker, or is it a bullish mitigation block? Ask the question. This should be easy, since you already figured it out for the bearish stuff. This is for the bullish stuff. Purple is bullish order block. Alright. Purple is bullish order block, red or green. Very good. Legging or striker. Blue is propulsion. Blue is propulsion. Blue is not a propulsion. No. Blue is a new bullish order block on itself. But you got the other two right. That's good. For blue being propulsion would mean this would need to be a bullish order block. This is not a bullish order block. This is just a random candle. um, but yeah, this is a new bullish order block, and the reason this is a new bullish order block is because it's forming right below this SR level. Now this is why I chose these SR levels and the order blocks, because it's not necessary that the down candle has to be formed at the exact SR level. No. But the down candle should be responsible for punching the market above the SR level. That's the important part. And it was responsible for punching the market above the red SR level in this case, which makes this a bullish order block. Same thing over here. Like, this down candle was not exactly formed after reacting to this SR level. Like, it was like third candle after this reaction happened. So even though it's not exactly reacting off of the SL level, the upward movement started from this down candle. So this down candle is the most significant one out of like severity. Like this order block is not as strong as this order block because it's deeper in the discounted window. Like this is the second strongest bullish order block. This is the first strongest bullish order block down below out here. So that's good. I think you got it right with this. Jeff, did you have the same answers or different? Yeah, I could tell. He needs some more coffee. Okay, let me take some more examples in so that you can like tell as the market unfolds when a new bullish order block is formed. So we know that this is an SR level, and this is the next SR level over here. Let's play it out a little bit. Now remember, we discussed this example in the last lecture. When this down candle was happening, as the market pushed above, it punched above this SR level, right? So this down candle, which was the initiation point of this push, this becomes a bullish order block too. So, you know, it came very close to tapping that bullish order block before it went up. Now, after this pullback happened and it pushed up, this became a propulsion block. And this is forming at the exact SR level itself. So that means if it comes back for a retest, propulsion blocks are pretty strong. That's a long, and it punched up again. Now this is a new bullish order block information. Why? Because this was an inside daily candle. This is why I love inside daily candles, because when you have an inside daily candle like this, which you should be able to recognize by mapping this out, you take the lows out, reject it and go higher, and you close higher. When you form this, like I've discussed how you should be longing it. So what you're doing is you're longing the bottom of the bullish order blocks. And once you catch the bottom of the bullish order block, you can be rest assured you caught some kind of a bottom and it's going to stay there for like days and weeks to come. So you came back to retest it, rejected again, went up, and then it kept going up, right? And you eventually like tap this SR level. So to recognize that there's an inside daily candle, you can be very, very sure that once this bullish order block is formed after it forms the inside daily candle failure, the retest is along and go for this SR here, which it did. So this is how the order block theory is helpful to like position on top of the market, even when it's like, you know, unfolding in an uptrend like that. Is this clear so far? Okay, good. Now, eventually it kept pushing and it went further up into that SR level as well. I don't think we got any pullback to test any previous order blocks. It formed a new order block, which is over here. It looked like this. So if it were to come back down, that would be, this is an SR level, right? So you're forming this order block at the SR level. So if the market were to pull back, it should not go below this order block. And when you tap this SR level, notice what happened. You formed a new order block, which is over here. Pull back. That should have been a long. You should be longing this. Did it violate? No. Did not go below the low? That was long. Kept pushing. Easy $51 million. So now this down candle becomes the propulsion block because it's forming on top of the previous bullish order block. This is generally how I map the market when it's pushing. Like I have this all mapped out in real time as it's going. So you have a reference point on what to look at when the market does start pulling back and where you should be longing at. Now in this case, it never actually tested this propulsion block. So there's space here. That space has to be recognized that it was untested propulsion block. Okay, so you punched up. This is not a bullish order block, personally. I don't think so. This could be a bullish order block. I just don't like it as much. Like it's an inside daily candle, right? If you look here closely, that's an inside daily candle. An inside daily candle can only be a bullish order block after you take out the lows and then you punch it higher. You don't just like casually go up like that. So when you casually go up like that, these lows are vulnerable. And I would not be longing this bullish order block when it comes down because I know that the market is going to go for those lows. This is more so that I would be wanting to long. Okay. Let's see. Goes up, 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 up. What is happening here? That's an inside daily candle. Rejects. Could be a long actually. Where's the signal on the daily chart? Yeah, why not? We could take a long. That's an inside daily candle failure. Why would be wrong? This is a bullish order block, which it formed here. However, it formed in the middle of nowhere, which is what you need to be careful with. If you see a formation happening like this, right in the smack middle of nowhere, there's no SR level here, by the way. Like even if I scroll out on the daily chart, this is the only level I can think of where it's possible. So I would rather think of this as a bearish order block. This could be a bearish order block because you actually closed in this candle here, and that's a major resistance level too. So when you have this down close candle being bullishly engulfed, I would not call this as a bullish engulfing or not a bullish order block. Yep, it wasn't a bullish order block. It was just a bounce. Tested the SR down, so it's going to go for this low, most likely. And it did. See what I was talking about? That you should not be using an inside daily candle which has not taken out the lows and just like casually goes higher as a bullish order block. No, 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 no. That's a trap. Usually a trap. Now this is where I can like long the market. See that? Tops it, goes back up. Now this is a resistance zone. You should be looking for like a short, personally, over here. All right, that is a good short. Yeah. So you have what you call like a range, like a dealing range, where the market is finding support. Now it's finding resistance. And before a new trend can happen, I think it will like try to fake some people out before you can go forward. Let's try to break out from there. I don't think that's a good case. You should not be longing it over here. Mainly because I'll go into those reasons later, but it's this could be called as a breaker. Let's see. No, not a breaker. This is now a bearish order block. Yeah, this is a bearish order block. So you could short it and you can take it all the way back down to the if it comes back for a retest. Yep, that's right. Goes back down into it. If it tests it, you could possibly take another long. Yep. See how it's ping-ponging between the support zone and now it's like entering this resistance zone. If it goes into that resistance zone, that's a short. So you would be like Orderblock's would have saved your ass in this case. If you don't recognize it, you're lost. Like most people would be lost. But since you recognize that this is an order block, it should be rejecting it. It did, comes back down into it. That's a likely another long, given how it's respecting it. Okay. Great. Now this is like a very strong long, by the way. Not only like, it's but this is how I would approach it. Most might think that because it's breaking a bullish order block here, or this is what you call like a propulsion block. I would argue this propulsion block was tested once, twice, third time. It had to break the fourth time because it's weak now, right? That it's making what you call a low, oh sorry, a high, a lower high, lower high, lower high, lower high. So the pattern is signifying that this support should break. But once you do break the support, you are coming into a support zone which has never been tested before. And everybody's going short, going into a support zone which has never been tested before. Right? And I would take the other side of the trade and be like, I'm longing it. Like I'll start scaling into longs is what I would say. That's an inside daily candle. Woo! But that's an aggressive long, I would say. Aggressive long. Ha ha ha. See, I was right about it. Now, one of the main reasons that I took that long is because, sure, I understand that it hasn't really tested the support over here, but I'm trying to play the failed breakdown. Like everybody's trying to short this support zone because it should break down, and it did break down. And the moment I saw the first signal or reversal, like a swing low being formed, I'm like, I'm going long. I don't care if it wants to go lower or not. I'm okay being stopped out and then taking a long lower. But I understand the basic premise that, yeah, I understand this low is being taken out. This low, a lot of lows were taken out and everybody got liquidated and everybody's trying to short it. So the first sign of reversal is, yeah, you should be going on the other end because when it becomes a one-sided trade, you should not be a part of that one-sided trade. You should be looking to go on the other side the moment the market starts turning, which it was giving confirmation that it's beginning to turn over here. Like when this inside daily candle formed and you had a punch up, you did not close it. Like you did not close below the low. It formed like it formed like a confirmation that it's giving you like a reversal. If it would have like closed below this low, I would have waited. I would not have like tried to long it back then. But it was like a confirmation this is a daily swing low information. That's where you got long. That's a good long to take. Anyways, I think that's a good example to close the session on. I will resume the order block theory again for the next session because it's not something I can teach in like one session. It takes a lot of time and a lot of practice to do it. So we'll go over like in deeper examples on how to spot proper setup with the order blocks and how to like identify it properly as well. But I think this is a good introduction to order blocks, and we'll take it from there for next session on Thursday. Hopefully this was helpful for you guys, and if you have any questions, now is the time to ask me if something is unclear and how to implement it with the trading, or if there are anything unclear, just let me know. Yeah, practicing is good. Once you practice like for next 3 years, maybe you'll catch up to me. But I've been practicing this stuff for a while now. Like it's been 4 years, give or take, that I've been practicing using order blocks, SR levels, market structure, open levels, like all the price action concepts I taught. It's been 4 years I've been practicing it in real time. So you definitely need like at least thousands of hours before you can start practicing it based on where I am at right now. That's good. So do you have like a new sense of appreciation on how analysis happens for different markets, different charts, just by using pure price action, no indicators? I mean, yes, there's one indicator, which is opens indicator, but that's like doing the work for you instead of like, manually mapping out the open levels. It's just doing the manual mapping for you. So it's still like naked price action I'm analyzing. I'm not like using any fancy indicators. I'm not using stock RSI or Bollinger Bands or Ichimoku Cloud. That's good. With more practice, you'll get more reps in. Once you get more reps in, it will start pinging in your head on which setups are high quality setups, which are like mediocre setups, which are like low quality setups, and which ones you should like completely avoid. It comes to you eventually. So like for gold position, I was telling Jeff that he should hold on to his gold position mainly because I anticipate there should be like another run happening on these lows. Now, one of the main reasons I was saying that this is going to happen is because when you look at the 2-day chart, there's a inside 2-day candle here. Okay, what the fuck? Like this. So it took out the high. No, I'm expecting like it's going to take out the low. However, there is the confirmation of inside weekly candle failure. So the higher time frame pattern is telling us that it's going to go here with the inside weekly candle failure. But the lower time frame pattern is like, yeah, it might take out this low. But the bigger part which we have to think about now is that once you do take out this low, it should not close the weekly candle at the lows. It should reject this low when it takes it out and go back up again. So I want to see this week's candle to close above this range, which we have drawn out. It should continue to confirm that this is an inside weekly candle failure. Instead of like, if this weekly candle closes below this low at 2302, then I will have no option but to cut my option calls, which I've taken in GLD. Then it would be a loss. But if we do go down and we take out this low like I'm expecting it to do, I still don't expect that it's going to go down. Why? Because gold is setting towards rightly at this daily bullish order block. Now, the main reason I introduced this bullish order block theory, and anybody who made it till the end, they get to understand why I'm so horny about gold. Like, there's a pattern, which is the inside weekly candle pattern. You went down, you tested the bullish daily bullish order block. You're rejecting it over here. So I really don't expect gold to go below here, which is 2267. And the risk reward ratio is just fantastic for longs here. Like if you long it down here with a stop loss below this candle's low, and you take it all the way till there, that's a 5.43 risk reward ratio, which is why I'm willing to swing the gold option calls. That it may take time to get till there, but as long as I have time in my favor and with a proper stop loss over there, I'm not worried about the gold option calls. Like there are multiple things that like stacked in my favor. There's the inside weekly candle failure. There's a proper trigger with the daily SFP. There's a multiple patterns playing out. Like, yes, I understand this is a inside 2-day candle. It's running for like a sweep of this liquidity, but I don't really expect it to go below the daily bullish order block if it's going to do that. So another thing to realize is that this wick, which we formed in gold, that wick was not formed in GLD chart, which is the ETF for gold. So one of the main reasons I'm expecting that downside movement to happen is because there needs to be like a proper test of this bullish order block on the GLD chart, because that hasn't really happened on what you call like active time frames, the real market hours. That that spike down which happened, I took the position in gold and futures, but the real investors never got a chance to like actually enter it. So that bullish order block can be like properly be seen on the 4-hour chart for GLD over here. And if you map out the fibs like from this low, like this to here, see how the 50% is lining up exactly with the SR level I want to tag, or at least what I'm trying to say is this SR level is very important. I also did mention once that the 0.382 always acts as an SR level, which it did, like it bounced over here. But then eventually when it's going lower, it wants to tap the 50%. And if I take a trend-based fib extension from here, the 100% is lining up with that as well. Now, I haven't really explained how this fib tool works. I'll do it in one of the lectures, but I'm saving it for when we start the Elliott wave concepts. Like this month, I'm only teaching you the price action concepts, which is the SR levels, the market structure, the opens indicator, which we talked about. Now we're talking about order blocks. We'll go into fair value gaps, and we'll also discuss more order blocks in the next lecture. So once the price action concepts are done with, then I will introduce you to the world of Elliott wave, which is far more exciting than price action concepts. That it tells you what the direction bias is going to be for the entire market if you can understand Elliott wave. So from an Elliott wave standpoint, I understand that yeah, this is a correction going on, and there should be like another leg up happening because I'm expecting like a wave 5 to happen from here. Like this is a wave 3, this is a wave 4, and there should be like a wave 5 happening. And the wave 4 generally extends in time, and it almost always like either ends at 0.382. If the 0.382 low breaks, it goes to the 0.5, and that's a long one. So when you combine Elliott wave with price action concepts, it's like you smack down going into the minor details, and you can like almost cherry pick the lows if both of them can be like combined together. That's where like you can turn like an intermediate trader to like a pro trader to like an advanced trader if you can like if you can blend both the concepts together. But it will take time. Like obviously you can like learn all of this in like one setting. Like that's why I'm doing this mentorship so that I can like give you time to like absorb all the concepts, see them in action, like actually understand as things are unfolding in front of you, and ask questions if something's not clear, and then give you time to practice as well as we build along the previous concepts. So when you're building along those concepts, you're like learning new stuff on how I'm like adding new tools to add confluence to the existing analysis. Like earlier, we just had like market structure, like higher highs, higher lows, basic stuff. Then you introduce SR levels. Okay, if we understand if the SR level is defended, you have higher highs, higher lows, the trend is like going in your favor. Then we added the open levels. Like if you have the monthly level, we have the weekly open, we have the monthly open. If price is like defending it, making higher highs, higher lows, that's an SR level too. Good, things are in our favor. Now we added order blocks on top of it. That if the order block is sitting over here, if you have like opens indicator, like there's gonna be like a new weekly open as well, and you understand that prices above monthly open, which is great. We will have like a new weekly open as well, and once it taps and it goes above the weekly open, it's gonna like add into your favor as well. You have a daily bullish order block now. You also have the fib support on top of you, like I taught the fib tool. So you have like at least 4 or 5 different confluences from like different methods, which are like giving you signals that yeah, it should be like a good long in this case over here if it comes over here. Okay, so when you add Elliott on top of it, that's like the final straw, which should help you with that. And then in the last phase, we're gonna do like a cross market analysis where I taught you that if you're comparing this thing with like GDX, which is the gold miners, it's telling you that it's gonna go up. It has already gone up like this. So that's more of a confluence part as well. Like that's the 7th confluence you can get out of all the 6 confluences which we have already discussed based on like price action. So when you like keep stacking these concepts together one on top of the other on top of the other, like it really increases your probability on which trade setup you should be taking and which setup should be like being avoided. And that's all trading is about. It's about stacking probabilities in your favor. That's all. So hopefully like you're beginning to appreciate like how these sessions are done and what exactly I'm trying to teach over here, because it's going to go a long way. Let's say I stopped giving any kind of analysis of the markets. Like you should not be sitting over here hanging, thinking, what should I do with the markets now? Like nobody's here to teach me, or I should like find somebody else who should be like teaching me. But if you already know how to do it yourself, you don't really need to go anywhere for any kind of information. The information is right in front of you in the charts, like I'm showing it to you. So once you learn how to do it, then you're golden. Like that this is something which can be used to feed your family in the future if you want to, like if you lose your job or something, or like something happens in your life, or like if you want to like set up your retirement account, your savings account, or like a passive flow of income. You can use all these things to like generate that passive flow of income, aside from like the primary source of income you already have in your life. Um, I chose to like use this as my primary source of income, and I've been doing okay so far in the past 2 3 years. And obviously, it's like a journey. Like as you go on this journey, you will learn new things. You will learn how to scale up your existing portfolio. You will learn how to like diversify your investments. Like use these concepts to like apply it on different asset classes. Instead of like just doing on Nasdaq, you can do it like at least 20 different asset classes. So that if Nasdaq is not giving you like a setup, you can look into gold if it's giving you a setup. If gold is not giving you a setup, you can look into Bitcoin if it's giving you a setup. Like I haven't traded crypto in maybe 2 3 weeks because it's not giving me a setup. But does that mean I'm not making any trades? No, I'm still making trades. Like I'm still trading Nasdaq. I'm still trading gold. I'm still trading like Euro USD because those pairs are still giving me setups in a way, right? So when you diversify yourself in different markets, you understand that something somewhere is ticking, which is like in accordance with the concepts I know about. And if it's giving me some triggers to like enter, I can go and make money on that. Like it's a free market. Like just go trade whatever is making sense to you. And similarly, like with stocks, I will go into a session and I will show you how the concepts I am teaching you are applied to stocks. Like say for example, SPY and QQQ. Like it's the same thing, right? QQQ is basically Nasdaq, which we just discussed the concepts in. Like NAS 100 USD is the futures contract for QQQ. So QQQ is like the ETF which tracks whatever Nasdaq is doing. So if you want to like trade options on apply those concepts on QQQ, it's the same thing which I'm doing on Nasdaq, except I trade using like CFDs, which is like the forex equivalent of QQQ. Um, um, and that's like operation like 24 hours. QQQ is only operation like in the New York session, which is from morning of 9:30 a.m. to like 4 p.m. in New York time zone. Um, and you can like apply the same concepts on like let's say Amazon or Costco or like Meta. Like I've nailed Costco ever since this pattern broke out. Like I was discussing this pattern with LQABD and I was like long on this breakout and I mentioned that this breakout is gonna be insane when it goes. And you can like use the order block theory on Costco and see how I was able to enter long on this position over here when the market structure broke, understanding that once it goes, that the bullish breakers which are going to form in the process, they all will be acting as support as you go. And I suppose you can like eyeball the bullish order blocks which were forming in Costco, like the propulsion block which formed over here, which then acted as support. And as it goes, like apply those concepts in stocks, and you'll see that order blocks work very well with stocks, and they work very well with the SR levels. They work very well with even the opens indicator if you want to use it for like intraday price action. So yeah, like price action is like universal. It's not like specific to like forex or only the futures contracts. Like apply the stocks and see how it unfolds in front of you. You'll understand it very quickly if it is useful for you or not. Like I've traded stocks using options for like a long time, just using price action concepts. Like that, this is one of the main reasons. Like most of the people are in my group because they only trade stocks. They don't trade like Bitcoin or any cryptocurrencies or even future contracts. They just like trade stocks, and I've been like nailing stocks based on price action concepts for like a while now. Um, so yeah, like we will transition into like discussing some stock tickers, just to see how to apply the concepts based on what I've taught, what stocks should do. But we'll save it for like some other lecture. But in the meantime, I think this lecture got extended by more than normal. I'm not going to charge extra for this. It's just like something I wanted to discuss. Um, it's more to do with introduction of the price action concepts for order blocks because order blocks are very key to what we will be doing with trading. Like I use order blocks all the time. You have to like understand how they work because they're very useful. But most people get it wrong because they start using any random candle as an order block. And you have to kind of understand the backstory and the concepts behind what the backstory was. Like you have to understand what the SR level was. You have to understand if there was like a liquidity sweep or not. Like once you do understand that, you will begin to map out order blocks which actually do work, and that really reduces the amount and how many times you would get it wrong. Like it significantly increases your strike rate on what auto block works and which one doesn't. Okay, so hopefully that was useful, and I will catch you guys on the next mentorship program, which will be on Thursday. And until then, I will see you guys tomorrow when the market's open. Have a good evening. Bye.